Good morning and welcome to the Killik & Co market update. This week has been much less dramatic than last week, which was quite a relief to be honest. There's still a huge amount of focus on US economic data as people continue to speculate on when the first interest rate cut will be. Investors do want to see a little bit of weakness in the data, as that will mean that interest rates will be more likely to come down, and that would be good news for equity markets. But on the other hand, they don't want to see too much weakness in the data, as that could signal recession. This week we had the latest inflation data from the US and it came in at 2.9%, down from 3% the previous month and slightly below expectations. We then had retail sales data showing how much people are spending. This came in ahead of expectations. Here's the data over the last 20 years. There was a big dip in spending following the financial crisis, another in lockdown when people weren't actually allowed to spend, and then a big surge after lockdown, and then a gradual decline after that. But more recently, you can see a bit of a pickup. Markets seemed happy with this combination of falling inflation and strong retail sales, and we saw a rise in US equities this week. In the UK this week, we had the latest wage growth data. This was very strong in the COVID era, and there had been concern that it was causing inflation. Total pay, including bonuses, is currently growing at 4.5% per year, and that is the lowest it's been for over 2 years. This chart shows wage growth in the UK since 2001. The green line shows nominal pay, and the pink line shows real pay, meaning the increase over and above inflation. The chart is showing percentage growth, so as long as those lines are above zero, wages are going up. The green line has been declining recently, but it is still significantly above zero. The pink line was below zero in 2022 because inflation was so high, but it's moved above zero recently as inflation has come down. It's also interesting to look at wage growth in the private versus the public sector. Here we've got private sector growth in the green and the public sector in the pink. As you can see, private sector growth is generally higher, but it takes much more of a hit in times of economic difficulty. Just look at 2008 and 2020. That jump in the pink line was due to a recent pay rise that was given to nurses. There are reports that the new government is about to agree a pay deal with train drivers. This could cause wage growth and potentially be inflationary, but on the other hand, UK GDP growth has been negatively impacted by the high number of strike days in recent years, so a deal could be good news for ongoing economic growth. And finally, there's been a fair bit of focus on Alphabet recently following a development in the US Department of Justice's case against the company. A judge has ruled that Alphabet has engaged in anti-competitive behavior by paying Apple over $20 billion per year to make Google the default search option on its devices. The ongoing case doesn't appear to have held back the share price in recent years. Here it is, it's nearly tripled in the last 5 years. Despite that, the shares are actually less expensive than they were 5 years ago. Here's the price to earnings ratio over that time. The ratio is lower now than it was 5 years ago, and it's broadly in line with the overall S&P 500 index. Online search is still hugely important for Alphabet, but it has been diversifying more into other areas in recent years. Here's the latest revenue breakdown. 57% comes from search, YouTube in the bright green is now at a very significant 10%, and Google Cloud in the purple is up to 12%. It will be a long time before we have a resolution in this antitrust case. It's already been going on for over 4 years, and it's likely to go on for many more because of the appeals process. There has been some speculation that Apple rather than Alphabet could be the one to lose out here. The argument being that people will continue to use Google even if it's not the only option available, whereas Apple stands to lose out on that $20 billion per year that it currently gets from Alphabet. Definitely one to watch. Moving on to have a look at next week, the results are due out from Estée Lauder, TJX and Intuit. That's it from us. Have a great weekend, and we'll see you next Friday.